I
there.
was speaking on it, so don't count me.
Oh, okay. So you don't know, you have no idea what was said then.
Yeah, right?
So are you an attorney?
I'm Jillian Sidoti.
Oh, you're Jillian. Okay. No, we've never met.
I know.
We've been in a lot of same circles. Yeah, go ahead and give an overview
Sure.
of Jobs Act.
So basically what happened is the Jobs Act of 2012...
Let me back up
go ahead.
One place before that, sorry. In November of 2011, there was what was the Entrepreneurs Access to Capital Act in the House of Representatives, and that was sponsored by Rep. Patrick McHenry. When that left the House with overwhelming support, it got into the Senate, which of course is where horses get turned into camels, designed by committee, and that became the Jobs Act. So the Jobs Act is a rather messy document based on what was a rather elegant document originally. But it's
that turned into the Entrepreneurs turned into the Jobs?
No, Entrepreneurs Access to Capital Act turned into the Jobs Act in the Senate, which was then approved in April of 2012. So, sorry.
Yeah, so the Jobs Act is what crowdfunding is. And so everybody will say crowdfunding, is it a fad or anything? No, it is. So the thing about government is they recognize that the way business operates has changed, and this is their first attempt to rewrite the securities laws to update that change. It's not perfect, but it's a good move forward. So the Jobs Act had several titles. The only ones that you need to be concerned with is Title II, Title IV, and Title III. Maybe some of the others, Scott can tell you. Title II so Jobs Act was passed in 2012. Then it had to go to SEC. They had to write the final rules. And then September 2013, Title II of the Jobs Act, 506C, became legal. And that's the only thing that's been legal up until September of this year. So 506C is just a new exemption, like a 504 or a 506B. It's a C now, and what it allows you to do is to generally solicit your capital raise. Now, there are restrictions, and we won't get into it. It's only for accredited investors, and they have to be verified. We won't get into Title II. We'll get into Title IV. So Title IV is the other one that became legal. It took forever, but it just became legal. They finally passed the final rules in, September of this year. And so Title II of the Jobs Act only allows you to work with accredited investors. And where before, when you were raising money, anybody could be an accredited investor as long as they self-certified, they could sign the document. Well, 506C now, they have to go through someone like Fund America that will verify that they are and send you a certificate. And so you can advertise, but you're kind of limited in the people who could invest. So Title IV comes around now, and there are two tiers to it, but they call it a mini public offering. And if you do it right, unaccredited investors can invest, and there are two different titles to it.
Public-private offering.
Yep.
The SEC, it's a public offering, but basically FINRA considers it a private offering.
So this is where we're at too, is that there are a lot of fights going on in all of the different regulatory agencies and a lot more to be worked out. But so Title IV came around. Title IV, and if you get his book, by the way, he explains it brilliantly what led up to this with the regulations and the decimalization and all that. We won't get into it. But what it allows you to do is...
You keep wanting to go back to that because it's fun stuff. But
this
is a dry topic.
Yeah, it is. Well, yeah, it definitely is. So Title IV comes into two parts. They call it a mini public offering. So in the capital markets, if you're doing a smaller offering, I'd say under $100 million, it's difficult to find people to assist you with those kind of smaller raises. And I think Title IV, a mini public offering, kind of fills the gap between big IPOs and then smaller IPOs. So Title IV became legal. There are two parts in September of this year. There are two titles to it. Title I is you can raise up to $20 million, but your
Tier 1.
Tier 1, sorry. Tier 1, I keep saying Title 1. Tier 1, there are two tiers. Tier 1 allows you to raise up to $20 million in your capital raise, but you're still holding to the state's securities.
We'll get into that.
Okay.
We'll get into that.
And then,
one of our platform customers has an offering going through Tier 1, and I think it's the only one that I'm aware of. So
who is that?
I think it's public. GoClick.
Okay. And then Tier 2 we'll let you raise up to $50 million, and you can circumvent the state's regulators or the blue sky. Well, maybe. There's a big fight going on about that right now, right? I mean...
We'll talk about that too.
Yeah, as the law goes. So that's basically where we're at right now with Title IV. That's kind of a primer. I hope I did an okay job. It is a dry subject. And then you want to fill in some gaps, and then we can open it up to questions, and we can... I've got questions for you.
Well, everybody has questions, and Jillian, you can pitch in because you're going through a lot of this stuff, I know as well. And anyone else in here? Do we have any securities attorneys in here? Anyone securities attorney? Well, I know, but.
I was raising my hand. So
oh.
Sorry.
Oh, you're raising your hand already?
Well, no, I was raising my hand, so I was saying, yeah.
Yeah. Anyone else? Anyone else?
Man, come on.
It is early.
Down now.
I expected 5 people to be here. Second day of the conference this early.
I'm like Trump. They're coming for me. No, I'm kidding.
I just want to hear you talk.
Right?
I'll tell you this much. If somebody comes to me and says they want to do a tier 1, I won't let them do it.
Why?
Because before the Jobs Act, when I was doing Reg A's, they were so, like, I literally would be on the phone crying because I would get so many letters from states going, we just want to see this. And it'd be different things from every state. And then you'd have to try to organize and figure out how can I make this offering even work now, because every state wants something different.
Yeah.
And the filing fees cost more to, like, at the end of the day, you can get an audit cheaper than you can pay all the filing fees you have to pay. Like, Nevada's $5,000 filing fee.
Wow,
so.
yeah.
California's even more.
Yeah.
Well, just a quick primer. So, Reg A, by the way, is been around for, 50 years? And it was an exemption or something like that.
It's been useless.
Yeah, you could only do up to $1 million raise.
$5 million.
$5 million, and it just was cost prohibitive. It costs more to do all the due diligence than to raise the money. So I think it was used, I looked up, 8 times in the last 5 years or something. So they modified it as part of the Jobs Act, and they increased it. Tier 1 is $20 million, and Tier 2 is $50 million.
Let's go over some specifics of Reg A, or Reg A. You should have the Marley playing or something. So it's split into 2 tiers. Before, it was basically useless because you did not have state preemption, which means you have to file Blue Sky review in every single state. And what Blue Sky review means that every state, which is 50 mini SECs, you file with each one. And many of the states look at it not only on its technical, does it comply with securities regulations, but they also subject it to a merit review, which is where the state gets to go, yeah, it's legal, but you don't want it here. So infamously, Massachusetts rejected Apple on a merit review. So they protected their investors from, or their residents from that horrible stock. But the states like that. Nobody wants to give up their control or their power base. And so when the Jobs Act was approved, primarily NASA, the state securities administrators, went nuts because they want to continue requiring all filings to go through each state securities department. The Jobs Act preempted that. So the SEC basically split the baby by creating 2 tiers of Reg A. And under Tier 1, people could file with the states. And NASA made their case by creating what's called coordinated review. And under coordinated review, all states are, in theory, banding together for a single review point. You submit in Washington, they appoint examiners, and then it goes through review for all the states, which is supposed to make it easy, in theory, for issuers to use Tier 1. The Tier 2, you just file with the SEC, you don't file with the states, and you don't have to worry about the state review of the offering. There's some other things that you have to worry about, and we'll get into that in a second. So the pluses and minuses, though, under Tier 1, you can only raise up to $20 million. Under Tier 2, you can raise up to $50 million. And it's not 20 to 50, it's 0 to 50. So you can use Tier 2 if it's a $5 million raise or a $10 million raise, just like you could use Tier 1. So Tier 1 is 0 to 20, Tier 2 is 0 to 50. There are for accredited investors and non-accredited investors, they can self-attest. In a 506C Title II, you have to reasonably confirm an investor's accreditation. And, that's one of the services that we do for platforms all over the country. It's a big, annoying thing. But 506C is literally the only exemption where you have to confirm an investor's accreditation. So under 506B or under Reg A or anything else, people can self-attest. So they can say, I'm accredited, I'm worth more than $1 million, excluding my personal residence. And the issuer can accept that at face value. Or if you're a non-accredited investor, they can say, I make $100,000 a year in income and I have $250,000 in net worth. Self-stated, you don't have to verify it. You don't have to pull tax returns, run credit reports like is required for Title II, or do things like that. So either way, Tier 1 or Tier 2, that's the case. In a Tier 1, there are no limits on either accredited or non-accredited investors. So a non-accredited investor can invest as much money as they want in a Tier 1 offering. In a Tier 2 offering, accredited investors can invest as much as they want, just like Tier 1, but a non-accredited investor is limited to 10% of the greater of their income, their stated income, or stated net worth. And that, a lot of people are confusing that with Title III of the Jobs Act, thinking, oh, that's an annual limit. It's not. It's a per deal limit, per investment limit. So they can invest up to 10% of the greater in this deal, up to 10% of the greater in that deal. They could keep doing it over and over again. They don't have to limit that to 10% total on an annual basis and then divide it up among a number of deals. It's a very common misperception. The other benefits are, under a Tier 1, you don't have to have audited financials. You have to have reviewed financials. Under a Tier 2, you have to have an audit. So they have to be audited. And then for ongoing reporting, under a Tier 1, when you complete the offering, you file a notice with the SEC saying, yay, we raised money. Under a Tier 2, if you have more than 300 investors, which in all likelihood you will, you have ongoing annual and semi-annual reporting. So you have to file a semi-annual statement that is a reporting light. It's interim financials and any material changes. And you have to file an annual report, which is not like a public company where you're filing full review, but you do have to file audited financials. You have to file analysis of your top 3 compensated executives and material items and business discussion and things like that. So it's public reporting light on your annual filing. Yeah.
Do you have issues similar to an IPO where your numbers will go stale after a certain period, or?
You're talking about like trading volumes?
No. When you're in your document where you're filing, where you've done your audit.
They're easier. It's easier.
Oh yeah.
Yeah. They still go stale, but it takes like 9. Instead of like normally they go stale in like 3 months. Mm-hmm. It's 9 months. Okay. And it's kind of a weird convoluted thing the way it reads. But if you go to the year end, then you have, like I have one that's in process right now, and we have to file before September 30th, mm-hmm. because the year-end financials will go stale by September 30th.
Right.
So.
Okay.
Yeah.
How many years have to be audited?
2.
And what if you're you're rolling up a new entity?
If it is a new company that hasn't been in existence for 2 years, then you have to file an audit for the time it's been in existence.
So if you're using the funds to acquire, is it like a 314 audit? Is it the same? Is it similar to that?
That you'd have to check with your attorney. It depends on how you're doing the roll-up or the acquisition. Are they timed concurrent with the funding, and then you're going to make the acquisition? So basically you're creating a fund, which you might have some 40 Act issues you have to work around. Or have you done this and then you're raising it for the combined entity?
You're raising it to buy the project.
Then you'll have to have audited financials for the affiliated companies. Most likely.
Oh, well,
for the acquisition.
If you have a target, and you haven't acquired it, you don't have to audit until you acquire it, but then you would have to do the equivalent of an 8K once you acquire it.
It's a matter of time.
Yeah, personally, what I have been doing, because you don't know what the timing is going to be with the SEC, is I'm sorry.
No, go ahead.
No, this is an open forum, by the way, for everyone to talk. Yeah.
Let me just take over here.
I'm kind of interested. Can you actually use this on a startup? Because you can't, in a public, it's very hard to use a startup to raise money for a startup.
Every single one of mine are startups, and the reason being is because, if you were just going to do a straight syndication, how long is that seller going to let you have an open contract for until the SEC gives you approval and then you get your financing and then this, that, and the other thing? So you can't take that chance. So what I've been doing is just funds, and pre-jobs, all I did was just funds, and it was brand new funds, no assets, no history. Usually the operator had some kind of history, so we put a prior performance table in. And truthfully, I won't write a Reg A the way, there's 3 different ways you can write a Reg A. You can write it as a Reg A, you can write it as a Form S1, which is a public offering for non-real estate companies, or you can write it as a Form S11, which is a real estate public offering. If it's a real estate offering, I will only write it as an S11 because I feel like it's the most comprehensive and it will get through the fastest.
Well, S11 is mature and has no limits on it.
Right.
Well,
but I write it to look like that, but it still is within the
for a Reg
limitations of
A,
Reg A.
yeah. You're writing it like an S11.
Yeah. So I put, because if you look at the Form 1A, it's like fill in the blanks type information, and I know if I send in that fill in the blanks type information, all that's going to result in is the SEC asking me a bazillion questions. So to avoid the bazillion questions, I put the kitchen sink in there.
Yeah, so one of the things about crowdfunding is that look, this is not new. This is just like especially in Title II, this is just an additional exemption. And in Reg A, it might not just be that Reg A is your solution. You might use a different. So you don't need a broker-dealer. You can self-host all of these, but I would recommend that you go to a professional because it gets complicated when you start dealing with the SEC and how to submit it. Let me tell you
you cannot do this yourself. You have to use a
You have to. I mean, legally you could, but you have to use an attorney.
It'll never make it through the SEC.
Yeah, exactly.
You have to use an attorney.
You have to. Well, an experienced one. An experienced one. Go ahead, yeah.
It seems like this is a substitute for a traditional venture raise, right? I mean, can you guys kind of compare and contrast the costs and benefits of?
Yeah, let's talk about just a few other of the basic technical aspects of it. So we talked about the reporting, the differences in Tier 1 and Tier 2. Many people ask about, well, how can I raise money? Can I do things concurrently? Can I do a 506D or a Reg S and a Reg A or other kinds of things? There are ways to do that. You can raise money via Reg D for 506B or C right before you launch your Reg A. You can do a Reg A concurrently with a Reg S. You cannot, if you conduct a Reg A after that's conclusion and then you want to raise more money with a 506, you have to wait 6 months. So there are certain technical rules that you want to make sure you work with your securities counsel on. Also, that something a lot of people are overlooking is in addition to a 1A filing with the SEC, you also have to file a 5110 with FINRA within 1 day of your SEC filing. So that goes to the Corporate Finance Department for review to make sure that compensation is not unfair. And some of our clients, have already got their filings, and then we point out to their securities counsel that they forgot the 5110, and it's, oh shit, you're right. So it's something that...
this is why you have to use a professional, all the numbers and acronyms. No, I understand it. Well, so one of the things about a Title II is you can do a shelf so that you can get it ready to have, so that when you find the assets, you can close on it right away. I mean, look, we're not doing a Reg A, we're exploring it. We like to test the water part of it also, so I'm not sure.
You can test the waters with that. One of our customers, Elio Motors, is testing the waters, and they got $34 million in testing the waters commitments, and hopefully their offering will get approved and go live sometime next month, how it's looking. But there are a lot of issues. You have states now saying that you have to register in the state before you can do a testing the waters.
There's still a fight going on.
There's a fight going on over that. So be very, very careful.
Even on the Tier 2?
The what?
Even on the Tier 2?
Yeah, even on the Tier 2.
The state regulators don't like to be left out. That's the, right?
Yeah.
Is there any wisdom to avoiding Massachusetts and whatever Minnesota or whatever the other state is in terms of offering because of the uncertainty about their lawsuit or whatever?
You have Montana. You have a number of states which are very hostile to Tier 2.
Right.
Massachusetts leading the charge, but
Montana
and Ohio.
You get your Reg A approved, and you go out and raise, and then whatever happens with that, are you sort of grandfathered in, or should you just avoid?
No, you're grandfathered in. You can't just because there are lawsuits going on. It has no impact on the viability of the rules that you have now. But there are some issues in both, and with a Tier 1. Some, as Jillian started to point out, you have coordinated review. You have to pay the state filing fees during coordinated review. You might not even get approved, but you spent perhaps $20,000 or more just in state fees. You're spending $50,000, $75,000 in legal fees. There's another $20,000 in state filing fees. You have about another $5,000 that you're going to pay FINRA for the 5110. So you're into this for a lot of money. The state filing fees really can add up fast. Coordinated review is only 45 states. You have several states, most prominently New York, that doesn't even participate. So you have to file separately with them anyhow. It's a very expensive pain in the ass.
One of the things is about capital raise is go as small as you need. I mean, I see a lot of people, they want to do a national strategy to raise $50 million. I mean, do you really need to go national? I mean, if you know what states most of your investors are going to go with, maybe look, we're talking about federal exemptions, right? I mean, but states, 13, 14 states have their own crowdfunding laws that may make more sense for your raise. So like Fundrise is a good example, and they've been doing Reg A Plus in the Washington, D.C. area, I think it's Virginia, and it's a state filing, but all of their investors come from a limited geographical area, so why bear the burden and the cost to go national if you're not going to use national? Does that make sense?
506Cs too, because I've invested in a couple of
them. Well, I'm no expert on Fundrise.
Let me just hit one other thing about Tier 1 filings, in addition to the state filing requirements, in addition to the fact that not all states are participating in coordinated review. Much said, well, gee, the audit is more expensive. If anyone's ever had a CPA review of their financials, that's not cheap either.
Yeah.
So you have to do that for a Tier 1. So the gap between reviewed financials and audited financials is not that big. So if you look at the costs of the filing fees for a Tier 1 versus what it might cost to get audited from reviewed,
is that PCAOB also?
No, it's a lower level.
Yeah,
it's
exactly.
Lower than
it's just gap. The other thing is that when you go through coordinated review, you are subject to merit review, not just factual review. So you might still have states go no. And then another unknown is some states have not yet decided whether or not they want audited financials. So you may file a Tier 1 to avoid having to audit your financials, and one of the states steps up and goes, California might step up and go, they got to be audited here too. So you could be screwed no matter what if you go with Tier 1.
I don't think we answered your question. So you correct me, you guys know better than I, but so to do a Title I or a Title II, the cost for a Title II is roughly, $75,000 to move forward?
Title IV.
Title IV, sorry, Title II, or Tier 2. I keep saying Title. Tier 2 is what, about $75,000?
It's going to be about the same either way.
Well, what about Tier 1?
Rough numbers.
Yeah, no, of course, yeah. Well, look, has anyone went through the SEC? You said no. You think?
None have been approved yet, but there are several on.
Yeah.
A lot of them, I file all mine confidentially, so you wouldn't be able to find any of mine right now until they're approved.
Yeah, and nobody's been approved, right? I mean, so...
I guess ground floor, but they
filed I read that, yeah.
They felt like it's kind of a...
It wasn't really a Title II filing, it was a pre-filing.
It was filed before this was even approved, so they had filed it like a year ago.
Not a good case study either.
No.
We'll see how that goes.
Our LEO is the first 5110 in FINRA, so we got a notice from the Corporate Finance Department that basically the entire Corporate Finance Department was going to review it. So that's happening now.
Yeah.
Not so quick.
That sounds awesome.
On the you mentioned a shelf. How does that work if you're you file a shelf at the same time as you're coming under the A+, you don't have to be seasoned and out there for a year?
Well, so here's, let's say that who are dealer or fund guys, property owners, managers, I mean, that's probably everybody here, right? So I know when I speak to these guys, it's 506C, B, 51010, it gets everybody lost or whatever. So if I was doing what we're going to do, we have a 25 million portfolio that we're taking down. So we'll do a test the water campaign and see where our investors are and if we want to go forward with it. And then you can get approved. Correct me if I'm wrong, by the way, because you do as well. But you can get it approved, and then that approval is good for what, a year, 2 years? How long is the shelf?
For a year.
So I can get it approved as my company if I don't have an asset ready. I guess it would be more like a blind pool kind of thing.
Yeah.
And then go find my asset, and then I have it all ready to go, and then I just can go out there, and if I did a test the waters, I can go to the guys who gave me commitments, or I can go as soon as I have the property under contract or ready to go. You know what I mean? So it's 2 years?
If during this time anything changed, it's highly likely to be considered a material change, and you'll have to submit an update for review.
Well, so how long does an update take to get approved versus the initial submission?
It doesn't take as long.
No.
Okay, so it could be, it's new, it could be an option for you. I know some people who are thinking about doing it that way, that they want to get into the Title II, but they don't have anything for it yet, so.
You don't have to have anything for it.
Yeah.
Like, and as a matter of fact, if my client comes to me and I say, if time is of the essence with these properties, this is not for you. So like I said, every single one, I have one right now that's like we might buy hotels, we might buy single tenant retail, we might buy this. Then I have another one that's multifamily, but no properties have been identified at all. It's all blind pool.
Well,
when you buy those properties, do you then have to? You mentioned an 8K.
Yeah.
Do you then have to audit those 2 years back? Because those have been in operation.
No. You just have you take in the asset and you audit the asset as is.
Starting from the day you take it in. When you take it in.
Correct. And then the other thing is that I don't know if this was mentioned, but the audit requirements under Tier 2 are not the same as a public company.
Right.
It's a lot less. It's not.
Well, there's no Sarbanes-Oxley.
Yeah, you don't need to do PCOAB. It's a lot. It's a lower requirement. So your auditor doesn't. What are you really paying when an auditor is auditing a shell company? What are you really paying for? You're not paying for the audit. You're paying for them to do all the PCOAB paperwork that they have to do. So we eliminate that paperwork when we do a Reg A Tier 2.
Is the 8K, is it like the Super 8K with the reverse merger, or is it just a regular material event?
It's much simpler, and it's definitely not like a reverse merger because you're not changing the business. The business is staying the same. The difference between a Super 8K, is like, oh my God, here are all the risk factors, here's what we're doing. With an 8K, with an asset acquisition, you're literally looking at, here's the property we bought, and in 71 days, we're going to get you the financials for that property, and that's how it reads. Now, I don't know, I have to say, I don't know if it's a 71-day thing, or if you can wait till your semi-annual report to provide those financials. That I'm not clear about, but if it was a public company, it would be 71 days from the date that you.
But you already raised the capital in the initial.
Oh yeah,
you're not issuing under a shelf. You're just providing disclosure on the property after the fact.
Correct.
You're raising the capital in a blind pool.
Correct.
You're not sort of doing the equivalent of issuing
just for
at the market.
Real estate operators who are new to raising capital, that once you get approved, you still got to raise the capital, and blind pools are harder to raise money for than specific, right? So just know that just because you have a blind pool doesn't mean you can raise the money.
You don't know what it's a blind pool, right? You don't
know
how many assets you're going to have. You don't know how much they're going to cost.
Absolutely.
So is it like a multi-close option? Like, can you do you raise 10 million, and that's how, and then as you get the assets, more people come in, and then you do another 10 million.
Yep.
You know what I'm saying? So to approve to the full level makes logical sense because you're going to spend the flat cost no matter what to file it, right?
Correct.
So you go for the 50. If you raise 10 and you close on 10, and that's all you get, you're done. But you can keep it open for a year and re-raise as many times up to 50 million. Is that
Correct.
true?
But the thing is, what I want to say about that is that what I say to my clients when they first come in and say, hey, I want to do a Reg A is, well, how much money do you want to raise? And 9 times out of 10, they'll say $50 million. And I'll say, okay, can you manage $50 million?
Yeah, can you put it to work, right?
Yeah, can you find enough assets? Can you raise that money?
But you won't know, right? That's my point.
Right. So then they say, well, I don't know. I guess I could be comfortable with 20 or 30. So what I say to that is, okay, if you're comfortable with 20 or 30, that's what you should be raising. Why would you send something into the SEC that says, I'm going to raise $50 million and go off into the sunset? They're going to say, they're going to ask the same question I just asked. How are you going to do that? What's your use of proceeds? And my use of proceeds is super granular because, there are so many, let's take my hotel retail fund. That one, I don't even know what kind of property he's going to buy first. Mm-hmm. He doesn't even know. Right. So I have to really get down to, okay, I believe my acquisition costs are going to be 3 to 8%. Here's how that 3 to 8% is broken out. Right. I believe the first property I'm going to buy might be hotel. If I don't raise enough money, maybe I'll buy a small apartment building. I have to go through all these what-if scenarios. But at the end of the day, I didn't let him write it for $50 million. I think we wrote that one for $25 million because I said you have to really consider how much can you accomplish in a year. With all your other assets that you're managing, how much money can you raise? How much money can you deploy? And that's how you want to do it. And if you want to do another offering after that, do another offering after that. But you got to be realistic about it. Otherwise,
you can re-raise in a year.
I am so sorry.
No, that's okay. This is an open forum, though, so it's,
Clarify one thing. Yeah. Can a pure startup who doesn't have 2 years of audited financials use this tool?
Yes.
Yeah.
Yep. Anybody can use it as long as you meet the test, but you don't have to be an ongoing business. You have to realize it's expensive, and a lot of people don't. We'll hear things from one of our platform customers will come to us and say, yeah, we have an issuer that runs to raise $150,000 on Reg A. It's like, yeah, you really need to read more. There are a couple other things, just gave us a note to wrap up, a couple other things to keep in mind just real quick. With the states, if you use Tier 2, you don't have to submit the offering to review for each state, but just as with a 506, you have to file a Form D with each state. The states are looking at ways to extract money out of people by filing requirements post-raise. That's happening now. Some are ridiculously expensive. And then there's actually the securities themselves are exempt from state review. The act of selling those securities may not be exempt from state blue sky broker or dealer requirements, securities requirements. That is a bit of an unknown right now, whether or not you can have any kind of an issuer exemption. In general, a lot of states are taking the position that if you're using general solicitation, you don't qualify for an issuer exemption. Even under 506, the securities have to be at least executed by a broker-dealer. Have your securities attorneys check that before you roll anything out. So, sorry, yeah.
Yeah, I just want to, going back to the numbers of what's the threshold of would be reasonable, size of money that you should target. What's the minimum?
I figure it's going to cost you $75,000 to $100,000 in all your filing fees, legal fees, and filing fees. You have your marketing expenses on top of that. What's it worth to you?
Yeah. The capital raise, you don't start the capital raise with looking for the exemption, right? Find the asset, and then you need to have a plan how you're going to raise the money, because just because you're approved, you still got to raise it, whether that's with a broker-dealer or an investor database that you have. You should have those capital fundraising, you should have a deal and experience in those deals, and then you should have a path to raising that capital, right? And then once you have those, then you find the exemption that makes the most sense to you, whether that's state, whether it's crowdfunding or an existing exemption. Look, 506B is still a great exemption, still the most popular.
Well, pretty much nobody really qualifies for 506B anymore because people always tweet that they're raising money or something, and here's their exemption like that.
Oh, done, right?
Yeah, they're done.
I should write that down, by the way.
Remember, if you're going to conduct a Reg A, why are you conducting a Reg A? The only difference between a 506D and a Reg A, the only reason to conduct a Reg A really is for liquidity. You want to move it, get it public, work towards OTC or NASDAQ or something like that. That's your path. But really because you want non-accredited investors. Okay, why do you want non-accredited investors? Is that your business model? For most real estate companies, 506 is the way to go. But for some, one of our customers, Rich Uncles, has been working with a California exemption. They've now filed an S11 for a $1 billion filing, and we handle everything for them. They're doing that because they run radio ads like crazy. They want lots of retail investors. That is their model, and it works great for them. They're knocking the cover off the ball. So understand, if you're going to use Reg A or any other public filing, why you want to do that. Don't do it because it's cool, or don't do it because, ooh, I can raise $50 million. You can raise $50 million with a Reg D. You can raise $500 million with a Reg D. $1 billion, you can raise whatever you want. So it's much lighter regulation, relatively. It's much easier. Reg A is really a pain, and it's expensive. So if it's because of liquidity reasons or retail, non-accredited investor reasons, that's why you want to go there. But look in the mirror and really understand why you're going to spend the money and the time and the effort before you do it.
Really fast, the housekeeping before. So we're done. So there's a break, and then the conferences will start across the hall. But, I'm here to answer questions. I don't know if, Scott, you can answer, and Jillian, if you'd like to answer. We're here to answer as much as I can. I certainly don't have the depth of knowledge that they do, but I'll do my best. So I just needed to give you a housekeeping update. You got a question in the back?
I was just curious from listening to this, and we actually have a registered public filing that we're in the process of. It escapes me a little bit. I'm not so sure I see the advantages of a Reg A over a regular public. And also in a regular public, I can actually...
You go ahead.
Okay.
You kicked the bear with that one.
Yeah, a public offering, the PCOAD is way more expensive, the audit requirements.
And from going through that, honestly, I'm not quite sure, because I'm a small company, I understand exactly what you're saying, and it's not as an extensive for a smaller company.
Right.
And my audit costs more than what you're quoting, but I think you're right anyway. But I'm just sitting there, if I'm raising $100 million company, I'm not quite sure. That's why I'm asking. Hit me again. What's the advantage of you versus mine? And my guys, they have a secondary market.
You can have a secondary market with Reg A. One of my clients is going for the OTCQB.
That's what it doesn't say.
Yeah. So.
But once you're on there and you're that size, you got all the.
Yeah, well, you still only have a semi-annual. You still only have an annual. Whereas with the public offering, you have not just the 8Ks, you also have the quarterlies, you have the 10Ks. I mean, if you sneeze in a public offering, you have to, do something about it.
Redisclose it.
You guys mentioned you have an 8K requirement though also, right? Anytime you do
but it's so much simpler. I mean, it's just such a simplified process. I'm coming from a place that I've done both. And I'll tell you right now, 9 times out of 10, I will recommend the Reg A over the S11.
For anybody that's been an investment advisor, it's like ADD 1 versus 2.
If you're in the process, and I know your situation where you're almost done, I would stay right where you are, because there's no reason to change courses right now.
But I'm also sitting there. If you're 50 or 100 million, why are you on the OTC? It's the same reason you flip to the ASDAQ anyway.
Right.
So then you have all those requirements anyway. So that's why if you're going to go through those requirements and do the filing, I'm paused on why you do that, because if you do a little extra work and you're now registered, all your guys holders,
I told them
secondary market.
All right, they're kicking us out of here.
Purcel, I always learn something from you. I hope I add anything.
Oh yeah, no, it's great. It was fun speaking with you. This is great.
Yeah, I always learn something. Jillian,
I meant to get it yesterday.
Let's go. I mean, it kind of correlates to the question I had, right? If somebody wants to raise something on the
Okay.
You didn't need his card. I mean, all of these guys, they're. Hey, Sydney, stick around and you get Lou also. Yeah, give me a card too.
You're here. Okay.
Yeah, it's easy. I mean, you're in my single-family space, but they got a lot of money.
Do you know what?
How's it going? Good.
Okay.
Your colleague. No, Belinda's. Okay.
A quick question. You said what make a mistake on the 506 Bs for not
506B are both. That's well. So it's they have to be known to advertise that offering.
Right.
So you have to have a prior existence.
Yeah.
And then so, you know, it's an unlimited fund, you can have up to 35 accredited investors on that offering. But they self-certify, so, you know, so to be accredited, you have to be 250 grand or $1 million in net worth. But all I have to do is say, are you accredited when you sign it? And that's good on a B. On a C, I can advertise that offering, but I have to verify through an independent source. Yeah, so it's more strict, no accredited.
Most people on the 506B,
Basically, you're offering.
Well, he was saying as soon as you tweet out like I'm raising money, you've just blown that exemption. You can't advertise that offering.
Yeah, but if you have a database, you can push out the
If they are, we do.
database.
Yes, exactly.
Yeah, yeah.
CNA owns you prior existence, it's impossible for you to go to jail.
Yes.
Thank you.
It's good to know.
We are.
So yeah, this one is basically what we're doing is we have the cost where we decide that
I'll tell you what, I'll email you
allow the non-accredited investors also.
Okay, so you have to be careful what you
Yeah, so that's why we only have a timeline for the I do three education and crowdfunding. Maybe later on I'm going to have some.
Yes, yeah, I'll email you after. Okay.
I'll tell you what we want to do.
Yeah, so refresh me on what it is that Oh, okay. Yeah, let's meet up. I want to introduce you to some people, but I need to sit down with Matt and these guys, and are you going to be around here?
Yeah, as long as you're US based underneath.
Okay, for sure.
As long as it's not like reciprocal contract. China, whatever.
But it is Reg A plus or Reg A?
Well, Reg A is everything is plus is just, we did some of this, but let's talk, new form of. Right, exactly.
So what was this?
No, we have a fund.
Well, S11 is a read.
Might be cheap tonight.
So we're not, that's all.
And S1 is.
We'll meet up definitely. I want to introduce you to these three guys, and I want to talk to you about some of the pools we have. Hey guys.